This session is titled Innovation and Technology in Small Business Lending, as noted by both President Musalem and Governor Barr in their remarks. Obviously, a lot of enthusiasm for this session this morning, and very timely, of course, as well. As we've experienced yesterday, our goal is to hear from our academic moderator, hear from our presenting authors, get some feedback from our community bank discussant, and then our academic moderator will offer his comments, maybe synthesize the session, and then we look forward to Q&A. So again, just a reminder on those hot mics in front of you, if you do have a question, please be sure to turn on your microphone so that we here in the auditorium can hear you, and of course, our web stream audience as well. So our academic moderator for this session is John Hackney. He's currently at the University of Arkansas, and the community banking discussant for this session is Kenneth Kelly, Chairman and CEO, First Independence Bank, Detroit, Michigan. And with that, I will turn things over to John.
Great. Good morning, everybody. Welcome to this very timely and interesting session. After Governor Barr's comments, I'm especially excited to now project my voice onto the internet where it can be copied by deepfake. So that's great. So I'm going to get out of the way, and we'll start with Jeff from the University of Missouri. He's going to talk to us about AI in banking. So take it away.
All right. Good morning, everybody.
Good morning.
Yep. Before I get started, I just want to, show my appreciation to the conference organizers for the opportunity to present our research here at the St. Louis Fed. And our paper titled U.S. Banks Artificial Intelligence and Small Business Lending, Evidence from the U.S. Census Technology Survey. This project is co-authored with Philip Wang, who is Associate Professor at the University of Florida, and Diana Wang, who is at Baruch College, City University of New York. So before I get started, I just want to issue a disclaimer. So any views that I express in these presentations are those of the authors team, are not those of the U.S. Census Bureau. So we ask a really simple question, which is, how does U.S. banks' adoption of artificial intelligence affect their small business lending practices? So before I get down to the bells and whistles, I just want to give you the highlights of our paper. So we find that AI enables banks to lend significantly more towards borrowers who are geographically more distant from the bank branches. Secondly, we find that AI allows banks to identify decent borrowers with high quality credits at loan origination. I think it's unquestionable that small businesses are extremely important for the U.S. economy, right? They account for 44% of the U.S. GDP, but account for more than 60% of the new job creation. Despite their importance to the U.S. economy, 85% of the small business owners reported that they face financial challenges on a day-to-day basis. Yet, only less than half of them are able to have their financing needs met. So the issue in this market is that most of the small businesses, they are private, so they provide very limited amount of public information. This makes it really challenging for the bankers to identify their credit risks and to assess their ability to repay the loans. So the conventional solution has been relying on the local interactions between the loan officers and the small business owners. This solution, although can alleviate some of the information frictions, it inevitably restricts the lendings towards borrowers who are geographically approximate to a bank branch. So we focus on artificial intelligence because we have already seen the impact of AI on the banking industry. So there has been some projections that the AI could create more than $1 trillion of values for the US banking industry. And some of the executives in the US banking industry even projected that AI could be as transformative as electricity and internet. So it's in particular in the small business lending settings, so AI could be particularly helpful in many regards. Among them, they can first help bankers to analyze a large volume of data more efficiently. And in addition, it could, some of the AI techniques such as machine learning can help bankers to identify the nonlinear relationships in the data. And in addition, some of the AR charged tools, such as voice recognition, image and voice recognition, as well as natural language processing, can assist bankers in collecting more borrowers' information at a fast pace. So we are already seeing abundant of anecdotal evidence in the U.S. banking industries where banks of all sizes are implementing AI to revolutionize part of their businesses. For example, JP Morgan is currently using AI-powered software to review commercial loan contracts. So works that has traditionally been requiring thousands of human labors can be finished within seconds. M&T Bank, they use AI platform to monitor cash flow health, credit risk, and lending opportunities on a continuous basis. The end result is amazing. They were able to enhance their risk management practices as well as elevate their lending strategies. Seattle Bank, which is a community-based bank, is partnering with Judy AI and using AI to simplify the small business lending process. They were able to use the AI tools to streamline the loan applications for small business borrowers, as well as speed up their credit decisions. Despite this anecdotal evidence, in academic literature, there is a very limited amount of empirical evidence on the adoption and the impact of AI on the lending practices of US commercial banks. The key impediment is that there is a lack of systematic data that measures and quantifies advanced technology usage by the banks. We circumvent this challenge by using the microdata that is made available by the US Census newly available technology survey, which provide us with one of the largest and the most up-to-date data sets that is available on advanced technology adoptions in the whole world. This data has several advantages. So first of all, it asks the banks and the firms about the specific technologies such as artificial intelligence, cloud computing, some other software, and robotics. This is in contrast to some other data that measures the overall tech budgets or tech investments by a given firm. Second of all, it directly measures the AI usage in the production of goods and services instead of asking the firms and the banks about whether they have an AI expert in-house. Third is that the responses to the technology survey are mandated. So non-response is a violation of the US Census Act. So therefore, we are able to circumvent the problems of selection biases and non-response bias. And lastly, it covers the whole universe of both public and private banks, so which gave us a more complete picture of adoption of AI in the US banking industry. So this is an example of the survey where, as you guys can see, it specifically asks the respondents about their AI usage in the production of goods and services, and they gave a really specific definition of artificial intelligence. So first of all, I want to give you guys some descriptive statistics that coming out of our analyses. So we find that the percentage of banks that adopt AI or use AI to some extent has increased from 14% back in 2017 to 43% in 2019. The natural question for us, or the first question that comes to us is, what drives banks' adoption of AI, right? So what are some bank characteristics that can explain their adoption of AI and the usage of AI in their business practices? So we find that larger banks are significantly more likely to adopt AI. However, some of the other bank characteristics, such as their loan portfolio, their capital and profitability ratios, do not have significant explanatory power for the bank's decisions to use AI. The first set of analysis that we focus on is on the effect of AI on credit supplies. So the data set that we use in this setting is from the Community Reinvestment Act, right? So this covers all the commercial banks that is regulated by the OCC, the FDIC, and the Federal Reserve System that are above certain asset threshold. The data set that gave us really granular data on the number and the dollar volume of small business loans that a particular bank issued or originated in a given county. Using this data and pair this data with our technology survey data, and we have some findings that I want to deliver that to you. So mainly, we find that banks with greater AI usage are able to lend significantly more towards borrowers who are geographically distant from a bank branch. What is amazing is that this effect is really unique, as we do not find similar effects in other types of technologies, such as cloud system and other software and hardware. And in our cross-sectional analysis, we find that the AI's effect on distant lending is more pronounced in areas with less bank presence, which means that in the areas that is traditionally underserved by the banks. So in our second set of analysis, we focus on the intensive margin, which we look at whether AI can help banks to originate loans of better quality. So this question is really important because some of the advancements in lending technologies that originates between 1970s and the 1990s, although extend the distance between the borrowers and the lenders, they lead to higher default rates. So that's why more loans does not necessarily translate into superior loan performance. So we complement the CRA data with the SBA's data, which is from their flagship lending program, the 7A program, which provide detailed information about at the loan level as well as at the borrower's level. So we find that banks with greater AI usage actually experience lower default rates among the loans that they provided to the distant borrowers, which is very encouraging. So this suggests that the banks with greater AI usage are not simply taking on excessive risks. They were able to use AI to identify high-quality borrowers that were probably ignored in the prior model. Lastly, we focus on the effect of AI on the risk assessment decisions by the banks. And in this setting, we focus on loan pricing. And the effect of AI on loan pricing is actually ambiguous. So on one hand, if AI allows banks to identify high-quality borrowers, they can probably charge them with lower interest spreads. But if AI helps the banks to capture these borrowers, maybe they can just get away with higher interest spreads. So in this setting, we focus on the interest spread that is charged on the loans at the loan origination. And our finding is that it seems like the banks with greater AI usage charge decent borrowers lower interest spreads at loan origination. So I do think that our study had some policy implications. So I want to borrow a couple of parts from the keynote speech by Mr. Brandon Mulhorn at the ICBA Capital Summit this May. Basically, although the community banks hold about 11% of the assets in the banking industry, they make 37% of the small business loans, and they originate 63% of the agricultural loans. And in 1/4 of the U.S. counties, a community bank is the only banking presence in that county. And in his keynote speech, Mr. Mulhorn mentioned that effective adoption or incorporation of new technologies is especially crucial for the community banks, as it allows community banks to reach new depositors, cut operational costs, and provide financial products with lower cost, and reach to communities that were previously underserved. So I think our study contributed to this discussion in the sense that we highlighted that AI has a capability to help community banks, in the sense that it extends the outreach towards borrowers who are geographically distant from the bank presence. And in addition, it helps the banks to supply more credits towards distant borrowers at lower cost, right? Which should translate into more job creation and a stronger economy. With that, I just want to thank you for your attention and time, and I'm looking forward to the discussions by John and Ken. Thank you very much.